Welcome to PlotLines, where we'll use our over 30 years of experience in real estate communications to uncover the real stories behind real estate. I'm Heather Crowell.
And I'm Britni Acriveau. Dive in with us as we invite guests to break down the ever-changing landscapes of real estate together. All right, welcome back to PlotLines, everyone. Really excited to be here today for a special episode on a very hot topic in the news, which is the 50-year mortgage. Here to help me break it down today, we have Tom Hutchens, the president of Angel Oak Mortgage Solutions, and Chris Carter, the VP and production sales manager for Univest. Thanks, Tom and Chris, for being with me today.
Great to be here.
All
Good
right.
morning.
Well, why don't we start with some quick intros? Tom, we'll start with you.
Sure. As you said, I'm with Angel Oak Mortgage Solutions, and we are a wholesale residential lender, nationwide lender. We focus primarily on what's known as non-QM, which is kind of just non-agency, so loans outside of Fannie, Freddie, and government FHA type loans.
Okay.
And we've been doing this at Angel Oak for 12 years, and I've been in the lending business for a long time. So lots of experience on residential lending.
Awesome. Happy to have you here. All right, Chris, on to you.
Sure. So, I'm like Tom, a seasoned veteran of the industry. Been in mortgage banking since 1990. Been with Univest for the last 10 years. Univest is a semi-regional bank that covers several states and has a 150-year history. So, we do primarily, the qualified mortgage lending, your A credit. Um, residential lending, but we also do commercial. We have several other business lines like wealth management and insurance as well.
Awesome. All right. Well, it sounds like we have some real expertise on the panel here today. So appreciate you guys doing this. All right. Well, there have been no shortage of headlines out there about the 50-year mortgage, this idea of a portable mortgage. So there's a lot being discussed. But before we even get into both of your takes on it, let's just break down these concepts to make sure we're all speaking the same language. Can you guys help me? Let's just talk about what is each, what are just generally the pros and cons that are being discussed about both the 50-year and the portable mortgage? Whoever wants to start
Yeah,
is great.
I mean, I can the 50-year mortgage
Yeah.
is just typically residential mortgages are 30-year
Yep.
amortization schedules. Some people do a 20-year or a 15, they can shorten that,
Sure.
but 30 years has really kind of been the maximum. There were a
Mm-hmm.
period of time in the early 2000s, there were some 40-year loans that were put out there. And really
Okay.
the idea behind it is just like anything, Americans, it's all about a payment. Like, what's the payment? And so to me, the thought was just thrown out there as, hey, let's instead of 30, why don't we go 50? That'll greatly reduce the payments. And,
Right.
um, it sounds good. You look at auto loans. Auto loans used to always just be 2 or 3 year financing. Now they're 5, 7. Talking about extending those.
Yeah.
So
Yeah.
as prices go up, extending the term of the payments will reduce the monthly payments.
Mm-hmm.
But there is a downside. But Chris, you can add to it or talk maybe a little bit about the portable mortgage if you'd like.
Yeah.
Yeah, yeah. Well, on the 50-year, you're absolutely right. Like, and I was there in the 2000s when, for a brief, fleeting moment, we had 40-year terms in the non-QM area. But, look, we have two crises, right? As far as the housing industry is concerned, one is
Sure.
inventory or lack thereof, and then second is affordability. And affordability is really taking up the lion's share of the headlines right now. So, yeah, a 15-year term is a kind of innovative concept, and I think right now we need to kind of be creative and see how we can maybe solve these crises. The affordability issue is probably not going to be solved by one thing, and same thing goes for the inventory crisis. But
Yeah.
as far as the 50-year, I agree with Tom. On the front end, great concept, looks good. Certainly helps people get into the houses and qualify for more. But the back end, what you have to deal with there is a slower grow to the equity position. You're going to owe that interest for a really long period of time. It's going to take forever to pay the thing off, and it creates other issues like
Yeah.
how you price it. For instance, like as Tom indicated, you have a 30-year fixed, a 20-year fixed, a 15-year fixed, 10-year fixed. Those shorter terms come with lower rates. The higher terms come with higher rates. So no sooner could you implement, in theory, a 50-year term, but what's that pricing going to be? It's certainly going to be probably substantially higher rather than the 30-year that we're accustomed to.
Yeah. All right.
And
And then help me
I'll just
understand the
add to it. I
yeah,
believe
yeah,
most homeowners have really thought 30 years, wow, I'm never going to
yeah.
pay this thing off. And then 50
Right.
years is just kind of like people, they take their age, they add 50 and go, I'm not what? No, no
Yeah,
way.
yeah.
So I think there's some marketing challenges around it too.
Sure.
Uh-huh.
But when you really break down the numbers and look at the interest cost on a 50-year term, I mean, traditionally the average lifespan of a mortgage was less than 5 years.
Right.
Now that has changed post COVID with
I think I saw it was 12, actually 12 years. I read an article this week that said 12.
well, I think they're factoring in what's happened over the last 5 years.
For sure.
Post COVID, no one has refinanced, or I'm sorry,
Yeah,
they've refinanced, but no one has gotten out of those 3% mortgages. So that's one of the challenges that trying to solve for. And I just don't see 50 years being. I mean, really, especially when you look at the
yeah,
interest paid, if they were to go to full term, it's almost double the interest paid
Right.
on a 30-year. And then, as Chris pointed out, the rate would actually be higher than the 30 years. So when you factor that in, there's probably not much savings even on a
Right.
on a monthly basis.
Yeah, I
yeah.
think
So
I
so
think
your point yeah. Go ahead,
Go
Chris.
ahead. Sorry, Brittany. Yeah. So I mean, I think what you're solving for is probably a very minor or few part of the market. You're not attacking this thing
Yeah,
overall, and then it kind of segues into the portable mortgage as well. So
I was
portable
gonna
mortgage.
say, yeah, the portable, yeah.
Yeah, yeah, interesting concept again. The predominant issue with it is gonna be that all your residential mortgages, all your real estate housing, it's all collateralized by the subject property, right? It's
Yeah,
securitized by the home, and then therefore that gets bundled. It's a commodity on the as part of the mortgage-backed securities on Wall Street. So when you've got interest rate and terms that are basically fixed to a piece of real estate, how do you pick that up and violate the mortgage itself, right? Like, which is a legal instrument. It's a illegal contract. So, taking the interest rate with you sounds great.
right.
It certainly solves the problem for those who are afraid to move upsize, downsize. If they can take that interest rate that they've enjoyed so much since COVID with them, that's wonderful
Sure,
for
yeah.
them. Yep. But it doesn't solve the problem for, let's say, your first time home buyers or anybody else who's just coming into the market.
Fair. Yeah, yeah, but it could help potentially with the supply issue. It's interesting because I bought my home in 2020 at a, like, 2.5% rate, right?
Right.
So, I mean, you understand why people don't wanna leave. But it's interesting because I was reading this week that apparently the US is actually pretty behind on this concept of portable mortgages. That's already existing overseas.
Right.
Is that something you guys are seeing as well?
Yeah, that has been out there. It's just, kinda
Yeah,
to Chris's point, that all the mortgages that have been securitized, that they're contractually bound to that
right.
collateral, to that property, and, then I was also thinking about so assumable mortgages have been around, and Chris can
Okay.
speak to that because I think that's more of a government type product where
Sure.
when someone else buys that same property, that mortgage can stay, and they'd have
Mm,
to qualify and everything else. But that's different than what we're talking. Portable means you've got the 2.5% like you do, Brittany, and you take that
take
with
it
you
with
to the
you.
next
Yeah.
property. Well, this person who owns the bonds that own your mortgage, they don't know that, you're going from XYZ mortgage to another value and another
Yeah,
loan to
yeah.
value. I mean, like all the parameters change
It's more
about it. So
complicated than it just sounds at the surface level, right? That you just up and take it with you and go to the
yeah,
next home,
absolutely.
right?
And then you think about, well, who is that gonna benefit? That's gonna benefit current homeowners. So that doesn't solve for the first-time home buyer, for
Yep.
the multitude of renters that are across the country that are trying to become home buyers. Portability would probably actually make it worse for them
Mm,
because people would pay more for houses because,
That's
hey,
right.
Brittany, you got your 2.5 mortgage, 2.5%
That's a fair
mortgage.
point. Yeah.
You're gonna bid properties up, or if you're competing with somebody who's would have to get a current mortgage at the 6.25 rate. So
Mhm. Mhm.
it again sounds kind of nice, but in all actuality, I don't see it being feasible.
Yeah, I
Okay.
agree with that. I mean, I appreciate what the government's trying to do. Look, we're trying to solve a problem that's been plaguing us now for several years, right? So you've got to come up with something to kind of break the ice and kind of move the market around. Interest rates have already started to soften up a bit. I know it's been very stubborn. They're not coming down to the levels that we would hope to see, but a target rate of, let's say, 5.5 on a 30-year fix. Well, that does two things at either side of the spectrum, right? People in the six, sevens, and eights who've incurred those rates over the last couple of years, they have something to come down to. And people in the twos, threes, and fours now look at something in the fives and say, well, that's not so bad, right? It's not as intimidating as six, seven, eight.
Yeah. Yeah.
So that itself can solve the market. But of course, you're waiting for the market to cooperate and accommodate, which it's not going to do on a whim. The other thing is, I think we've got to look at maybe other products and programs. I will say one thing that came up for a hot minute just a few weeks ago was the idea of removing some of the LLPAs, which are loan level price adjustments. That did not get a
Mm.
lot of press. The headline wasn't around too long, but I will say this: like we've gone to a risk uh, based pricing model when it comes to interest rates, and that's as a result of the last financial crisis. So that's a measurement
Sure.
of okay where somebody credit score is and are they repaying and can they repay accordingly and how do we charge them for that, right? So it's a good
Mhm.
concept. I
Mhm.
like it. I think over the recent years, though, it's become a real cash cow for Fannie Mae and Freddie Mac, and we've increased, let's say, those credit score thresholds from 740, 780, and now we're charging, pretty much premiums on and any price you can think of for type of property, loan size, credit score, equity position, on all that. So if you really want to help the affordability issue, to me, these novel ideas of 50-year mortgages and portable mortgages are, innovative in a sense, but I think they're not practical in application. So I think if you could
Mhm.
look at some LLPAs, if Fannie and Freddie really are interested in moving the market, maybe they could relent on that a little bit. I'm still all for risk-based pricing, but I think we've gotten it to a point where it's more onerous and not as accommodating to the American consumer, unfortunately.
Hmm.
Well, and
Sure.
to kind of add on to the LLPAs, one thing that I think could help is get the agencies out of the investor market.
Right.
They offer non-owner occupied investors. That just made me think of it, Chris, when you said LLPAs. That's an LLPA if you buy an investment property, but that just throws more buyers and continues to reduce the supply. So that
Mm.
first-time home buyer is now competing against someone who wants to build their investment portfolio. And
Yep. Yep.
that would help, and I think it would help tremendously, frankly, because there's a lot. Everybody maxes out how many Fannie Mae investment loans they can get, and then
Correct.
when they're done, I think 4 or 10. I don't know what today's limit is, but it's a number of properties
Yeah.
that that's not the mission of Fannie Mae to help
No,
investors get great rates that are insured by the government.
that's true.
Yeah. Well, you both led me really nicely into that next question, right? Do these products alone really help solve the affordability crisis? And it sounds like from both of your takes, no, it doesn't, right? There's other factors that need to be considered. What are some others that you guys haven't touched on yet that you think we need to be looking at closely?
Well, Chris started it off even with saying, the supply side, the
Yep.
supply challenge is
Yep.
really and I think what's happened is the federal administration has found they don't control that. They can't deregulate local
Sure.
housing permit processes, and that is where I say on the
Mhm.
supply side, that's the number one problem. You
Mm.
have so many municipalities, and I'm here in Atlanta, and now Atlanta has 20 different new municipalities that if you're trying to build in that area, you have to go to them, then you have to
Mhm.
go to the county, then the city. I mean, like it's just
Yeah.
layer after
So
layer
many.
after
Yeah.
layer. So all that means is delay and cost, and it just stops people from wanting to build. And
Yeah.
and that's
We're
how
not
the Fed
supporting development.
yeah,
Right.
well,
Right.
and but
Yeah.
that's what it does, and
Yeah.
so I don't know how Washington solves that in all the local markets across the country, but that needs to be solved. If that doesn't get solved, I don't know how the supply challenge ever gets resolved because it's just really difficult to do anything anywhere in this country. And then you go to some of the and you know, we're in somewhat of a conservative, non-regulatory market, but then you go
Sure.
to some other areas that are eh, heavily regulated. It's even harder and more difficult. So that to me is one of the bigger issues that
Yeah.
I think maybe the current administration thought that they could solve for it, but then realized, wait a second, there's five
It's
different
out
layers
of our control.
that
Yeah.
True.
in different markets that they can't impact.
Mm.
Yeah, I agree with Tom. I mean, cutting through red tape certainly, there's the shortage of houses, which is stemming from people like yourself, Brittany, having really low interest rates. There's no incentive for you
Yeah. Yeah.
to pick up and leave. I mean, we've seen an uptick in consumer loans, right? People say, okay, well, if I'm not moving, I'm going to do some home improvement projects, or I'm going to renovate, or I'm going to consolidate bills, or take out, loans for
A good time
education
for
or
the
whatever.
remodeling market. Yeah.
Yeah, yeah, and we're seeing like 15, home equity loans a day, right? So I mean, it's a very good environment for that because everybody is
Sure.
awash in equity, and they don't want to disturb that primary interest rate, right?
Yeah.
But again,
Yeah.
it
Yeah.
means now people are even more stuck than they were prior to. So to Tom's point, like what we need is more construction. We need more available housing, right? And we're
Mhm.
fortunate to be a construction lender. It's one of our marquee products here, but we're not the ones building the
Yeah.
houses, right? Like we're the ones trying to accommodate the financing for them. But certainly there's really no shortage of builders, but there's a shortage of property. And as Tom indicated, it's really kind of a slog when you get to regulatory stuff, at least certainly on the local level.
Yeah, and on top of that,
Yeah.
record amounts of home equity that are out there, there's record amounts of credit card debt. So
Yeah.
there are
Yeah.
the fortunate homeowners that have these
Like,
2.5% interest rates. They're using all that equity through
Yeah.
HELOCs that Chris mentioned to tap into that and pay down those high interest credit card debts. But Americans, they're just going to pay it off and then just
Yeah.
rebuild it again and then have to
for sure.
tap into it again. So it'll continue.
All right. Well, so there's there's no shortage of challenges here, right? But I want to hear a little bit about how Angel Oak and Univest, respectively, are helping support clients through all of this. So, Tom, maybe we can start with you.
Well, I think I started this that we are a non-QM lender, and that's I think just it really kind of defining what that is will help a lot. It's
Yeah.
our two key markets are self-employed borrowers
Hmm.
who have lots and lots of business write-offs because if you want
Okay.
to get an agency loan, it's your tax returns and it's your net number. That's what you qualify off of, no questions asked. But we look at it a little differently. We look at these self-employed borrowers and know that they have expenses, but we know a lot of their expenses are because of the tax code. So they're
Sure.
able to,
Mhm.
automobiles as an example and things like that. They get to subtract that from their earnings. And, that's why accountants have jobs because their job is to minimize someone's tax liabilities. And so we look at it differently. We look at cash flow from bank statements
Okay.
and it's not a subprime borrower. I think our average FICO is north of 750 and 75, 80% loans. It's really great product that we've been doing for over 10 years now with minimal defaults because again, these are business owners and having
Hmm.
had to be business owners. And then the second piece, as I mentioned earlier, was we do investor loans. We do
Hmm.
specialty investor loans for those borrowers who've run out of Fannie Mae access, or they're
Hmm.
also self-employed and can't qualify
Okay.
with an agency loan. So that's kind of what we keep saying. There's alternatives for people to still buy homes,
Mm.
and for a long period after the great financial crisis, there was no availability. If you didn't
Okay.
fit the Fannie or FHA box, you couldn't get a loan,
That was
and
it.
and
Yeah.
so we've worked really hard over the 12 plus years in making people aware of that. If you are self-employed, you have more options now
Okay.
to become a homeowner.
Yeah. All right. That's
Yeah,
great. Chris, what about you?
yeah, I concur with Tom. I think like near term, the solution is really products and programs. You have to be innovative. There are an expanded menu of programs out there and available, whether it's through the agencies or through investors, right? So, at
Yep.
the bank here, we specialize, as I mentioned already, on construction lending. That's not something that we see a lot of competition for in our market. It's very it's a complex and complicated process, but we've been doing it for many years, and we've got it down to a science with the technology and the full time dedicated staff. So we're there for people when they want to build a home or do some major renovation project. On the flip side, we have, I would say, at least a half a dozen first time home buyer oriented programs or affordable housing, and that doesn't include down payment assistance programs and federal, state, and local grants, right? So
Okay.
we exercise this, we call it like stackable grants where we could literally have like a 30-year fixed at a discounted rate on a local bond program and then supplement the down payment and closing costs with additional grants and down payment assistance programs. So, in the end, maybe a customer needs like, $1,000 or $1,500 out of pocket to buy the home, very
Yep.
little to commit, but at the same time, they're getting that, 30-year fix. It's not a speculative type of financing, and they've got it securitized and backed and things like that. But certainly, we're dabbling into some of the alt A products as well, as Tom pointed out. Like there's a market out there, and these things have been tried and tested, and they're very effective. And you really have to kind of open up cast a wider net, if you will, if you want to catch more fish. So I think that's the near term solution, right? Is the products and programs that you adopt and employ. You're just offering more for your customer base.
Sure. Okay. All right. Well, as we head into 2026, what are you both watching closely? I mean, I know we're all going to be watching to see what unfolds with these potential new products, but what else? What else is on your mind heading into the new year?
It's hard to look past rates and the significance of them. Chris mentioned, and I agree 100%. You get into the mid five range, which is what a lot of people are projecting and
Yeah.
forecasting, and really probably hoping.
Yeah, I was going to
But you
say.
get into the mid fives,
Yeah.
that's not quite as hard a pill to swallow. I mean, traditionally, the average mortgage rate over a long period of time is 7%, but
Right.
the 2.5 and 3% just spoiled the whole country. So
I know.
7% is kind of out the door mentally, but
Yeah,
when you
yeah.
start getting into the fives and mid fives and shoot, maybe even lower fives, then things really, I think, are going to pick up
Yeah.
tremendously, and it won't feel like as big a step to lose your 3% mortgage to go to a 5.5. And
Fair.
and
Yeah.
I do think people are ready to move. I mean, we are a very transient society here in the
Yeah.
U.S. and
Yeah.
everybody's been locked down literally since COVID, right? So,
Mhm.
I'm optimistic that 2026 is gonna be the year we kinda get to those levels.
Yeah, and I think I even read that the average homeowner is somewhere near like 40 years old now, or the average like buying a home.
First time home
So,
buyer,
I mean,
yeah. Right.
certainly that younger generation has to be wanting to get out of their apartments, right?
Yes,
Sure,
or
sure.
parents' basements or whatever,
Yeah,
yeah,
parent
Yeah,
basement,
yeah.
whatever.
Yeah, it's encouraging. I
Chris,
saw
what do you
yeah,
yeah.
that the economist for National Association of Realtors came out, and he was anticipating like a 14% increase in residential resales next year. So that's a strong number. We
That
haven't
is
seen a number like that in quite some time. So I hope he's right. He was very accurate just a year ago with his prognostication. So we'll have to see how that plays out. But yeah, all eyes are on the Fed, right? Like what happens to unemployment, what happens to inflation, what
yeah.
happens to the composition of the Fed itself, right? Like who's gonna be the new head chair and all that. How the markets react. I mean, right now, the markets haven't freaked out, right? They have not. Um, Responded negatively to this soup that we're in, but we definitely need some movement to get out. It's just been like a watching paint dry process with rates coming down because it's been so slight and subtle, and then you kind of plateau for a while. But we need I think sequential rate cuts, and it could be the end of next year that we see something that's much more appealing and accommodating to the market.
Oof. End of next year, huh? So we all gotta continue to be patient here, huh?
That's been the game. Yep.
Yeah. Yeah, yeah, for sure. Okay. All right. Well, I think you both know that the premise of the show is sort of giving guests the opportunity to rewrite headlines, and so we started with this conversation around all the headlines that are out there around these new products. So, I want to give you both the opportunity to write your ideal headline. What would you want to see out there? How would you want to see it positioned?
I think just I get asked this all the time: "Is now a good time to
Yeah.
buy? Is now a
Yeah.
time?"
Yeah.
And I tell people, you've heard it before. You marry the house and you date the rate, and
I
it's
love
it's
that.
100% true. And
Yeah.
I've had people that have bought houses over the last couple of years, and none of them have regretted it. So I would just say I would encourage people. There's great opportunities out there.
Yeah.
Um, Certainly home price affordability, buy something that you can afford, but I think you can also count on lowering your costs and your expenses going forward. I'd also love to see a headline that says all properties taxes have been removed nationwide. I think that'd be a great headline.
Yeah. Right. Oh my gosh. I like that though, Tom. Yeah, I mean, life doesn't stop, right? So we need to continue to push forward on life milestones and buy that home. And yeah, don't do it without outside of your means. But the reality is what it is, and keep things chugging along. All right, Chris, what do you think?
Yeah, I think we have to break the cycle, right? Like, rates are really what
Yeah.
created the inventory problem in the first place, right? Which is where we kind of still find ourselves. So we need rates to get us out of it, right? So we need that market cooperation. I think it's coming. I think we'll get it. Um, Once we have that, here's the issue, right? You could have a lower interest rate, but you're going to have higher prices too. Like, these property values are still, going up. Maybe they're not climbing to the extent that they have been, but,
Yeah.
it's still single digit growth is better than no growth, right? And, if people hesitate, to Tom's point, and wait for a lower rate to pop up, they might get it, but they also are going to get a price of a home that could be $25,000 higher than it was 6 months earlier,
True.
right? So you really have to kind of balance it out. And I think people do get hung up on rates to the point where they're not looking at what's the budget, what's the real cost, what's the payment, right? So I would
Yeah.
kind of,
Yeah.
while rates are important and that's certainly the headline, and I'm not saying it shouldn't be, prominent in people's minds. I think they need to understand, okay, what's my comfort level? What can I afford? And what is the payment on this thing, right? By the time I add taxes and everything else into it, to Tom's point. So I think it's just a matter of education. See what kind of
Yeah.
programs or products are available to you. But yeah, like Tom said, I wouldn't hesitate because prices could keep arcing higher, and meanwhile you're waiting for a lower rate that, like I said, I think it's sure to come, but it could be months away. So I wouldn't stop your search for that. You can always refinance later after you buy the home.
True.
So
Yeah.
And
yeah.
and I would add, I keep seeing all these headlines about the younger generation not wanting to be homeowners and all that. I
Mm.
totally disagree with that. I still believe it's the American dream. It's just harder now. It requires a
Yeah.
lot more commitment.
Yeah.
But I would encourage anyone that is considering it to make the
Right.
move because no very few people ever regret those decisions.
Yeah. Yeah. Well, and it's not like rental rates are really all that much
Yeah,
lower in some
Not a great
cases, right?
alternative.
right.
So to both of your points, like sit down, break down the costs. I mean, you might be surprised, honestly.
Sure.
Yeah, well, and that's when you're paying someone else's mortgage,
Exactly. Yeah,
that owner's
exactly.
mortgage, so
Yeah.
Sure.
help yourself out.
Yeah. All right. Well, Tom and Chris, this was really insightful. I really appreciate you both helping to break this down. Thank you so much for joining me today.
Great to be here, Britney.
Thanks for having us.
This podcast is a production of Gregory. If you enjoyed our discussion, please subscribe wherever you get your podcasts